Welcome to the new Barbarians podcast. I'm Bill Mann.
And I'm Mark Connors. And we're here to deliver insights on how current market events impact the traditional investment portfolios of stocks and bonds that Bill and I traded on Wall Street. Today, we see digital assets as the next frontier for finance and investment.
We're also here to explain how cutting-edge tools like AI and disruptive tech are the new barbarians at the TradFi gate.
So instead of Mike Milliken's innovation on debt financing with junk bonds, today's barbarians at the gate are changing the landscape almost daily across regulation, legislation, and finance.
So hit the subscribe button and let's cut through the noise together. Welcome to episode 14 of the new Barbarians podcast. Today's Monday, March 31st. The podcast will hit platforms later today. Today is the last day of the first quarter of 2025. We have some pre-market information to share. The Nikkei.
It's the beginning of the end, Bill. As you're about to say, what market are you going to look at first off?
So the Nikkei is closed. It has closed down 4% today. I haven't looked at futures now for about 30 minutes, but the S&P was down 1%. NASDAQ was down about 1.5%. Of course, Liberation Day is on Wednesday. And on Friday, we had some big economic news that I'll let you cover. But, consumer expectations are the lowest level in 12 years. Inflation was up more than expectations to 2.8%.
And Bill, you can't make that up in volume. If you have consumer sentiment low, which means that's how we generate GDP, and inflation's high, that's like being drawn and quartered in the village square. You're making less and you're paying more. So
I think we'll get to this, but as usual, we're hoping that the Fed is concerned about things like stagflation. Investors are still buying gold, given all of this uncertainty. And I'm looking forward to going through our charts in your scorecard today because I've already had questions. And as usual, I'm a bit confused about how we get to a better time for assets in the near term.
A better spot. And so we will or will not touch on the on Signal Gate out of the Department of Defense or the possibility of Trump's third term. We're trying to keep it focused on economics, markets, and players, and only empirical data that can lead to good investment decisions, and then maybe a better life for everybody.
Although I did hear, and maybe this is a little dated now, but actually it probably isn't, but I think the White House is now addressing comments made by Dave Portnoy from Barstool Sports about things like Signalgate, which, that's just another data point. I guess it's an interesting time to be alive.
Well, it is. And for folks, we want you to stay on because not only will we go through the markets, and we're really going to talk about why tariffs are going to be have a longer duration than we thought as podcast hosts and strategists. So we think the volatility is going to continue. We don't think we're going to have any resolution on Liberation Day, as Bill mentioned this Wednesday. And also, Bill's going to touch on ways in order to get your own news in. There's too much information. Or too much, I guess you call it information. It is noise. And then how can you either got to turn off everything or have a filter. And I think that's something we're going to touch on, using AI tools to help get better delivery of meaningful information that can make sense of the world. How's that, Bill? That's kind of what we think that's up and queued up for us later.
I think that is queued up for us later, and I'm definitely interested in the scorecard today. And as I said earlier, I went through last week's notes about the crazy news and the crazy market, and every week I say the same thing. So I am looking forward to trying and explain what I hope to do in order to make sense of the news and noise. And I will say that there is a lot of real news in there, but I don't know what's going to be the most important news to keep an eye on.
Yep, and that's why we discovered. And folks, as Bill and I talk, we all do our own independent work. Bill does his with his team. I do mine, and when we get together, we actually find new things as we turn rocks over. And even on this call, what we talked about in the green room in the prep, it'll change. So that's why we like having you here, and that's why we hope you continue to hit like and subscribe on this podcast. So here's our scorecard. We show 3 time frames because things are happening fast, and I'm going to bring up 3 things in particular. First, gold. It has to be. We first talked about it at the end of last year because it was the biggest year for gold in 2024 since 1979. So that doesn't really resonate because half the investors weren't alive by then. But remember, 79 was at the tail end of a 14x move in gold. So that was that was information, maybe not a signal. But since the year end, we've seen acceleration. The 1 year March to March move in gold is 38%. But the year to date or quarterly move is 17.5. So that's on the order of like 75%. But the monthly move is over 80%, close to, or I guess compounded would be over 100%. So you're seeing 38 1 year.
And
You're seeing.
Sorry to interrupt. I think that the 8.1% over the last month, because today's the last day of the month, so we can pretty much say that actually it'll be more than that, right? So the month of March.
because this is capturing. I have a live gold feed, so this is capturing. No, you're right, because this is as of Sunday. It's up another 1%.
Yeah,
you're right.
So March is going to be like, let's just say 9%, and that reflects all of the craziness that has happened since February 19th, give or take a couple of weeks.
Yeah,
but I was actually also surprised that trailing 12 months is like almost 40% because a lot of that happened before everything went off the rails.
And that you bring up, I think the fact that the Mag 7 ended 2024 up 63% and accounted for 38% of the entire market cap of the S&P. So in other words, on the upon the Mag 7 shoulders rested the whole market of $54 trillion of S&P. The fact that all of the volatility in the Nikkei, which was down 9.7%, I think, on August 5th of 2024. All of the increase in the deficit, which accelerated in Q1 25 fiscal year, Q4 calendar year, as the Biden administration spent going into the election campaign, all of that was masked. And what Trump is doing now is, scratching the needle on the record and, making everyone take off their headphones of, wonderful music and look at, geez, maybe there is a problem. And that's some of the data we're going to go through. So Trump is, he is not crazy. He's crazy like a fox. He may be dangerous as it relates to markets and things breaking, but there is a plan here, and it hasn't changed since he started talking a few months ago, loudly on, as you said, since mid-February, and echoed by Bessent and others in the administration. And that's what we're going to go through here because it has clear implications in markets. So you're right about that 40% move happening that global players were listening to, saying there's a problem here, Houston. And other people are like, hey, Mag 7's delivering my goodies. I don't care. But now the rest of the world is waking up to the fact that we have a potential reset on trade that is impacting markets. All right. So gold was the first thing I said we're going to talk about. The other one is Bitcoin. You folks all know that constructive on the asset for several reasons, not just the technology and the fact it's the largest, most secure computer network in the world. And in the last 20 years, if your company didn't have a network, you're not making money. So again, there is a new economy. It's not purely cash flow and discounted cash flow based. It's network based. That gives rise to cash flows, and people don't see it right away, like in Amazon and Google, like Bitcoin. But look at Bitcoin, month to date, terrible month for assets. As of Sunday, um, Bitcoin's down 1.8% in the month. If I had these updated now for U.S. equities, Nasdaq would be down about 8.5%, S&P down 7.3. Bitcoin's outperformed in March. You say, yeah, but it's down the year. More than equities, it is. But look at it's up on the 1-year basis more, 3-year basis, 5-year. Bitcoin has convexity. You see it a little bit here. It is down the month, but not as much. It has more upside on the 1-year basis. It's up, 2 to 3 times more than equities, but it's not down 2 to 3 times more than equities on the year or in the month. So I'm going to leave it with you folks on the call to ping Bill or I or ask for more research. Bitcoin's a real deal. It's acting better on or it's acting as it should, which is a little bit convex compared to other risk assets. So
And I think that what just occurred to me as well is, gold is up so much, which is, arguably a risk off asset compared
absolutely.
to all this other stuff. And Bitcoin is behaving more like a risk off asset than obviously equities and,
It is.
high yield.
It is. Yep. Yeah, Bitcoin is behaving. In fact, Bitcoin led markets lower over the weekend. So it has this Dr. Jekyll, Mr. Hyde sort of bifurcated personality, because we saw in March of 23, when banks were going down, all of a sudden Bitcoin got a bid as a safer haven in March of 23. It had like a 55% round trip in 2 weeks. It sold off quickly and then rallied immensely. And part of that was the liquidity pump that the Fed gave, which we're going to touch on later, because we are going to have a liquidity pump, no doubt, folks. And then obviously the other big standout here is oil, on the 1-year basis, on the year-to-date basis, and then month-to-date. It is compounding at almost the same rate. 4 times 4, that's about a 16% annualized on the year. That's what it did on a trailing 1-year basis, a little bit of overlap. And then month to date, 1.2 compounded, is somewhere along 14, 15%. So, oil is definitely, that's a stagflation risk that people are talking about. Tariffs reduce trade, reduce velocity of money. That's slow growth, maybe higher prices. No bueno. Can we do it all before midterms? God bless. So on to the next page here. How did we get here? So we looked at static, and that's good, but it's an abstraction. I think it helps to look at what Bill said, that date. What was it, February 19th, when things started to go sideways?
Yeah, the S&P was all-time high.
Yeah. And the markets this is why people love markets, because the story's right here. It's like it went through a strainer. And the risk assets, growth dropped. Dollar's a different story we'll touch on. Bitcoin Mag 7 down 15%. Mag 7 is going to be down 20%, I think, by the end of the week. We're going to open in, we are open. So I haven't looked at Mag 7, but I imagine it's down 2.5% or so, adding to this 15.5. But look at gold. Gold just took a leg higher. More uncertainty, more gold. And this is because I think Trump is rewriting the world order, the post-Bretton Woods world order of NATO-driven, Western dominance, and pushing cost of military onto Germany, who, thanks to Bill's AI tools that I now use, I learned about the debt brake And just like all German words, it's like, Schadenbragugeten, it's like a big long word, but it's in the Constitution, and it prohibits military spend and deficit spend. And it was put in after the global financial crisis because Germany, obviously, after the post-World War I inflationary devastation, they had one mandate: price control. They don't have employment as a mandate. It's price control, price stability. So they put in their constitution the limitations. They took it out this month. They took out the break. They now are going to spend 85 million euros more a year than they did previously to build out infrastructure and pay for military. So we saw markets change. And the reason why they were so clearly defined, Bill, is because we just had a once in a not generation, potential lifetime move by Germany being armed, because US is walking back our payment and subsidy of NATO and Trump foisting that on Germany, and it's going to be realized in greater deficit spending. So that's why I think this volatility is not going to go away in a V-shaped recovery like Tom Lee said, although Tom Lee is, I think, a great predictor of markets. We're going to have a little bit more kerfuffles to deal with as we test this 13% drawdown, which has been the place that we've always paused before going higher since 2022.
Hey, you, if you're listening, we need you. We need you to subscribe, please. And that's the drawdown with S&P, NASDAQ. Do we have a favorite to
S&P would be the number. NASDAQ would be a little bit higher beta, like a 1.1, 1.2 times that.
So we're looking at like 17% or...
Yeah, so NASDAQ would be 20, S&P would be around 17. And as you can see, as of Friday's close, we're only down 10 on the year, but that number is closer to 14% from a peak to trough basis.
Right. I think we should focus on the drawdown.
Yeah. So we're already at 14%. And who knows? I don't think we'll hit it today, but I think this week we could go into bear market territory. But this is another reason why I think we haven't fully priced this in. What you're looking at is a 1 year, same data streams, same markets, but on a 1 year basis. And the only animal in negative territory besides the dollar is oil. Again, that 15% number we talked about, which it's still compounding on that on a year date or 1 month basis. But Mag 7's up 18%. So if you're looking at your portfolio on a 1 year basis, and again, Mag 7 was 60% or up 60% in 2024, and it comprised 38% of the S&P. So it drove the majority of the S&P's returns. You're feeling pretty good. Bitcoin, you're feeling pretty good. Gold, you're feeling great.
And there's your drawdown for the Mag 7, right? Since February 19th, it's down 22%, around that.
Good call. Yep. Yeah, so Mag 7's in bear market territory. Will the rest of the market follow? Given what you said about consumption numbers on Friday, probably. Consumer sentiment. So that's why I think this is because I don't think this is fully priced in yet. People don't spend as much time on this bill as you and I are here, and maybe for good reason, because the news isn't great and doesn't make you feel great. But I think, forewarned is forearmed. And we do suggest that people understand the dynamics, because you're going to see, I think, more destruction in the markets in Q2.
It is tempting to bury your head for a couple of weeks.
It feels better. And the reason, so the other signal we want to talk about, and not the blue dot that's on your phone that that caused problems. And I'm not going to make light of it because that was obviously a whole nother discussion. But we're looking at the Nikkei. And again, the Nikkei is the equity market in Japan. Japan is the most levered developed market out there at over 230% debt to GDP. And it has existed in a very delicate balance. A lot of debt, but a low interest rate environment. And Japan was able to fund themselves because they're internal consumers of their own debt. They don't rely on governments. The reason why individuals or corporations would even buy JGBs, the Japanese governments, is because they stand still. At least if they're paying 5 or 15 basis points, that's something. Deflation is so big in Japan that it's a melting ice cube. So they can live on a no coupon bond because it's stable and the costs that they're experiencing are flat to lower. That's the disinflationary. It sounds kind of neat on one way, but it isn't. The family formation and the impact on society and culture has been pretty bad. If not entirely, but there are negative impacts to low growth. So the reason we're focused on this is look at August 2024, Bill. I think you had the sequencing of events pretty well laid out about why in August of 24, Japan experienced a bigger drawdown than other markets.
I think you have to look at that as a 24-hour drawdown too, because I think it was down, 20% in the morning and then, maybe 10 for the day or something. But that's a crazy one day, Monday morning drawdown.
Yeah. And when we were talking, you noted that it was a currency volatility. Remember, we say that the markets will be fine. You can have equities fall off 20%, but you can't have credit or currencies experience a break. If you have an extended break where there's a currency failure or a default of a large corporation or a default rate cycle, that's when permanent destruction happens. Your point about the 24-hour move was there was an unwind. I'm going to touch on this. James Lavish, guy I used to know from the business and then reacquainted myself when he got into Bitcoin recently, has his own Substack, did a good job that Larry Lepard also boosted about the carry trade and about how the government's going to help fund this basis trade in the U.S. A corollary for that is something called the carry trade between currencies. People sell the Nikkei, which is a very low interest rate currency, and they will use those proceeds to either buy equities in Japan, so there's no currency risk, or they may buy the U.S. currency, which has a higher interest rate. But the point is, you're selling the currency, the Japanese yen. What happened was the Bank of Japan changed policy because the yen was weakening too much, and they came in and bought bonds, JGBs, and they basically supported the currency. It forced all those folks who were financial players and just in it for trade to unwind. So they ended up having to cover their yen and sell equities, Bill. And so that just shows you, that line shows you how financialized our economy is going on. And that when you start playing with, when currencies get embroiled, it can have a tremendous impact on markets. So that's still there. We're still levered. We still have these risks. And I think we're going to take a pause here. And then we're going to come right back to our next section, which is defining why tariffs and exports play a lot bigger than that 3% number that people talk about as exports being on GDP for the U.S.
Thanks, Mark. And we also do need to still define Liberation Day, which I'm definitely looking forward to.
Yeah, it might be a holiday someday. I don't know. Hey guys, if you got anything out of that last segment, don't forget to like, comment, and subscribe, as it really helps us grow the podcast and bring you great content. Thanks for the support.
Hello again, everybody. Mark and I had to take a break. Today we're sitting 24 hours later on April Fool's Day. The quarter is now officially over, so we can wrap up our economics discussion for Q1 2025. And yesterday the markets were going to open down and they ended up flat. Overnight, Asia was mixed. Europe rebounded from being down, and gold hit a new high. So, and we're T-1 with Liberation Day. So, Mark is going to focus on imports and exports and their impact on GDP.
Yeah, thanks, Bill. Yeah, markets were all over the place. Some folks like Tom Lee said, hey, this may be a good entry point. He may be right. We always, that amygdala brain of ours, a reaction always does a bad decision at the wrong time. In markets, we get whipsawed, we sell at lows and buy at highs. So I don't discount him and what he says about, a down 10% off the peak on the NASDAQ, worst quarter since Q2 2022 for, I think, the S&P and NASDAQ, which obviously was the absolute epic rate rise that we had from 0 to 500 basis points back in 22. So that's why instead of looking at what has been going on, we're going to look at Liberation Day. What does it mean to put tariffs on exports and imports? How can it impact global trade? So let's go at the top of the funnel. GDP, the largest, most comprehensive economic stat that we have. It's about $106 trillion of global GDP. That's the number. And the US is about 25% of that. We are 6% of the population. We're 25% of global GDP. And we are about 40% of financial assets. So we, because of our status partially as the reserve currency after Bretton Woods, we really have been the core of the financial markets, core of the economy. And this is how it lays out across two of the six economics segmentations. G10, look at US. This is why we swing a big stick and why we say we're going to pull funding out of NATO. Everyone else says, oh my, how are we going to pay for it? Because we're more than six times bigger than the next largest at Germany. And then let's go us versus them on the BRICS side, who are looking to stitch together potential reserve currency, which ain't going to happen. But what they do have is they have a growing potential economy. China was something like $2 trillion or $1.8 trillion in 2001 before the end of the world trade. So this is what we're talking about. And then Russia, just a $2 trillion economy, but a lot of natural resources, including natural gas. That's why they had Germany over a barrel during the Ukraine war. So this setup, when you look at it, is sort of saying, all right, I understand why China and the US are now the supposedly, instead of the monolithic superpower, the multipolar world, which is what people are talking about. This is clearly gives you a reason why that is a relevant discussion. But now let's look at what Liberation Day is geared towards, and why I think some people are discounting it, and they shouldn't. In the US, the composition of that $28 trillion of GDP is 20 trillion consumption. That's 70%. We love to eat, buy, etc. in the US. We're very good at it. It's the largest composition of consumption of any country in the world. Us, consumption, 70%. Other countries are anywhere from 40 to 60. And obviously, some Northern African countries are lower. Investment, which is what companies spend and invest, is 5.3 or something like 18%, and then government spending also like another 18% or so. And export This is what people look at. They look at net exports, Bill, and they say it's less than $1 trillion. I'm sorry, yeah, less than $1 trillion of our 27. Who cares? Like, why are we fighting over tariffs when we should look at, either changing our consumption habits, getting margins higher for companies? Let's take care of our side of the street. So I don't know, in your circles or in quant AI, is this kind of attribution of GDP something that hits models, or let me put it a different way. You know where I'm going because we talked about this. There are 4 verticals. One ain't like the others. So do you want to go with where I'm going on the composition of net?
Sure. So quickly, I think macro models should, incorporate several of the drivers of economic growth, and economic indicators are used in many different kinds of models, including single stock models. You can use supply chain models, geo revenue models. There are a bunch of different ways that this gets incorporated, but I wouldn't say explicitly, and certainly not in these simple terms. And then on the net import export measure, which is negative, we're saying net exports. So the one thing I noticed here, and we are going to show on a gross basis how this number is very large. On a net basis, it's small compared to the other contributors to GDP. But obviously, imports and exports are, exports in particular are positive for U.S. GDP, and we're producing products and exporting them, and then imports are negative because those are GDP contributors to other economies. And the one thing I really noticed when we looked at the time series is how much exports decrease during a recession or during a slowdown in the US. And that really means that for the rest of the world, a US recession is a lot worse for them on a net basis than it would be for us, because they're so dependent on US consumption. Mm-hmm. And then if you look to the left of your graph, there you see it. Our consumption is, and I guess maybe this is a question back to you. Consumption is like 70% of our economy. Are we accounting for that on a gross basis, or how does the math work out there? We know that it's the driver for the U.S. and therefore really the world economy. But when we break things down into percentages, how do we get to that 70%?
It's on all goods and services that are produced, and it's durable goods like a washing machine. It's Starbucks. It's vacations, domestically, obviously. So it is that kind of consumption as opposed to a corporate investment in capital good, in computer services, et cetera. And then obviously government spending, which is something that we've talked about in previous podcasts, which is unfortunately a larger and larger part of that is the deficit spend, especially in things like healthcare that are supporting over a third of our employment. So we're relying on consumption, and we know that I don't know if it's 50 or 40% of U.S. citizens have less than $400 in their banking account. So you can't really rely on that vertical too much extended. Companies are becoming more frugal, more efficient. So they are a very judicious spender, an investment animal. And the government is at its end as far as what it can do. Scott Besson said, no mas on our 7% deficit. I'm going to squeeze it back to 3. So that vertical of 5.03 trillion, or, again, close to 20%, that's going to nowhere to go. So we're left with one vertical, and that's what Trump's going after. And I think this is what you looked at when you were saying that this is our net export imports. This is what usually people look at on that 0.93 or 0.9 trillion across 27 trillion, 28 trillion. It's anywhere from positive 1 or 2% back before the 70s. And as you said, during recessions, it goes to 0. So that, our cold is the world's flu. as trade surplus hurts them as well. But let's go to the next slide, because again, this is what I think is in everyone's consciousness, but this is what the game is about. There isn't just 3% of a net export-import impact on GDP, which is negative. There's a 25% opportunity set. If you really want to play with it, you could say that of that 25%, that's 25% of GDP in goods and services are either imported in the blue, 14%. That means that we're supporting other countries, or 11% of exports. So Trump's like, well, wait a minute. What happens if we just onshore everything? You know, is there enough demand internally where we could all of a sudden have that minus 3%, you know, take out our exports, be a 11% kind of number added to GDP? I mean, that's basically the opportunity set. You leave 14% the exports. You leave exports there, we're 11%, but you turn that 14% of, other way around, right? So you leave that 11% opportunity set. That's what he's going after. So we're minus 3 now. He wants to turn it positive. And again, we look at this, as you said, not only is it a gross number with a great opportunity set, but look at the import number drop much more than the export. So maybe that's why we have leverage, because of the trade surplus that we have with countries. So again, this I think is probably the most important graph I haven't seen as we are T-1 on Liberation Day for folks to look at. Trump's not crazy. People think he's dangerous, but he's crazy like a fox, because this is disrupting. There is going to be a toll to pay on the prices for sure, but it's not a game without an end or a potential benefit to the U.S.
And so I think this is the graph I was really referring to, and I'll just talk over it in case anyone isn't watching. So we show a time series of imports and exports, and we show them on, you know, one bar chart on top of the other. And, you know, over time, when you add up imports and exports, it becomes 25% of GDP. And when people usually quote contributors to GDP, like in that prior slide, you know, 20% of it, 20 trillion comes from consumption, and 28 trillion in total GDP is how you get that 70% number, which is sort of overstated when you then look at this, because if we only look at net imports, exports, it's 3%. And getting back to the number, it's like 1 trillion, and that's 3%. But if you look at this on just percentage terms, we have 14% imports and 11% exports. So that's where it's negative. But there's a lot more volatility around imports than there are exports. And so, you know, regardless of whether or not we are able to boost exports, you know, materially, let's just say that stays flattish, we can definitely replace some of the imports with domestically generated products. And you can see that that's just much more impactful on other economies. And that gets back to the quote where a cold in the US is a flu for the rest of the world, because I think this graph does show us some of that negotiation power. You know, during downturns in the US, it's much more impactful on imports, because, you know, consumption in the US goes down. But what this really shows us is that imports plus exports are at least an appropriate way to think about GDP, especially in this tariff regime, because if we only look at this net contribution, which is, you know, negative, but not as bad as it sounds sometimes. It's, you know, 1 trillion negative, which is obviously $1 trillion, and that's a lot of money. But overall, I do think it makes sense to look at this and especially the volatility around imports as being major contributors to GDP. And in that case, it is a negative contributor. But I think, by toggling that one, it can probably turn positive or flat pretty quickly.
And as you said, and I didn't pick up on that volatility on the imports over the exports. So by adding tariffs, what he's doing is he's potentially saying, instead of it being U.S. cold, our trade partners flew, maybe he's saying the other way around. If we halt the consumption or the importing by putting tariffs on them, he's then inviting one of these troughs for them. So this is what our trade counterparts are looking at. They're like, man, that '08 period was tough. COVID was tough. I don't want to go through one of those troughs that we see here and here. And that's the case. So that's why Crazy Like a Fox, this is by no means a fool's errand or a very risky, a risky gambit that doesn't have a possible constructive end.
Hey everyone, please don't make us resort to gimmicky ways to try and grow our audience. Please subscribe. Now,
So
on the flip side though, when we look at gross versus net with like an investment portfolio, like a hedge fund, I think that's often what you'll do from a risk standpoint.
Yeah.
Gross is very important if both things move against you at the wrong time and your net bet blows up, so your shorts lose money and your longs lose money.
I love how you're bringing your AQR risk management days to the economic examination here.
But and so I think that's really what people are worried about. Is this a gamble?
And they should be, because when you want to look at what regime are we on, we love quantum physics, relativity, but chaos theory is now obviously the theory that is probably embraced as the most relevant to how the world works, which means the butterfly wings. We don't know what happens. And that's why investors got low to ground, because chaos theory is the prism through which you should look at this gambit, Bill. So you're dead on, especially when you got the scariest portfolio during '08 or during any crisis that I examined as a risk manager was the big gross and the manager saying, don't worry, it always behaves a certain way. I know the behavior of the assets.
Right.
That usually ends in tears.
And, I don't think we have time to really go into, I wanted to kid around a little bit about the term Liberation Day, because it does sound almost like a propaganda term from history or something. But this is what Liberation Day means, right? If the gamble pays off, the U.S. is liberated from this net import export.
Yeah. It is from the and our trade partners are liberated from our trade surplus, which may not be the way they want it. So and it's what you're saying about the propaganda. I mean, Trump and his style, it is not without design. He is pulling from historic events, like you said. But we do have to wrap this up. So I'm going to end it here where we started. We started on a down Monday with the Nikkei down 4%, but a 3-day move that I think was on the order of like 6.5%. I mean, and remember, the volatility in the yen last year, led to one of the biggest equity moves. So that's a signal of risk off. The signal of risk off again is gold, mounting to an accelerating increase in returns year over year, quarter, year to date, and month over day, and month over month. Now we're going to leave you with this graphic because this is still unresolved. What this is looking at GDP in the U.S. through the Atlanta Fed's GDP Now. It's a now casting technique. And this is pulled from 327, I believe. And 2 points. What you don't see is the consensus by the Wall Street top 10 analysts, which is like a plus 1.6%, with a wide variance like 0.6 to 2.3% positive GDP for Q1. That's what the street's going out with. The Atlanta Fed's estimate is minus 2.8 as of March 26th. And 100% of that negative move comes from companies pulling forward goods and onshoring goods ahead of tomorrow's Liberation Day. So the 2 points I'm going to leave you with is we have a huge gap between what people are saying and what the nowcast, which has had a good record, is saying. So that is a potential for tears and a potential loss that people have not priced in, or a down 6% market has not priced in yet. The second point is this pull forward means a horrible ROI in Q1 for corporations, and have earnings accounted for that. So that's where, Bill, and a few final thoughts. We'll have some show notes for people on with some of these slides. Please hit us up with questions. This is what we want to bring you. Again, the majority of these slides, it's like I have a team of 3 or 4 people, have come from the construction of my research process based on Bill's LLM models that he has worked with over the past year. So definitely give Harmonic Insights a ring. You play like an army, but you are an army of one when you have the right LLMs.
I like that. And we do have to run, but this chart in particular, I think, will warrant a deep dive just in terms of methodology. Because if you look at this, it looks like over a 1-day period, GDP goes from positive to negative. And I think that that's just an important, like, time series analysis is my, it's kind of the food that feeds the machine, or the gas that feeds the machine, I guess. Yep. And that just warrants a deeper dive, and to understand that, I think we understand that this was front running tariffs, and net exports materially drew down GDP estimates, but it didn't happen over 1 day, and I think this will play through earnings, like you mentioned.
Yeah, and that's a short thing. All right, we'll leave you with a teaser for the next one. What Germany did with their constitution to increase debt, that is a bell you can't unring. Companies will recover from this. But what Germany's done, stay tuned for next week. Thanks, Bill.
Thanks, everyone.